Okay, so we're going to have a look at the 2019 cash flow question, folks. 2019 question 7 was a 100-mark cash flow question, and in your exam papers, it'll phrase as follows. It says the following are the balance sheets of Jackson PLC, public limited company, for the year 2017 and the year 2018, which we're going to call the old year and the new year. So to the left is the new year, 2018, and the beginning of 2018 or the end position for 2017 is to the right, the old year. They also give you some information at the top of the next page. There are 7 points of interest there which we need to take heed of. The first one refers to a share premium. We'll discuss that when we get to it. The second one is a disposal. The third one is an extra loan that they borrowed. The fourth one is the dividend which has been paid, the tax that has been paid or is payable, the investment interest that we're going to receive, and the goodwill being written off over a 6-year period or amortized. We'll deal with all of those as we get to them. But the first and most important thing that any student needs to have before they tackle the cash flow is they need to have the format or the template of you. The first part of this is an abridged profit and loss account. There's the structure. It's the bottom of your familiar final accounts, page 1. Operating profit, add and subtract interest received and interest paid. Take away any tax, take away any dividends, add on last year's P&L balance. And then you have got to learn off these. There's a reconciliation of operating profit to net cash flow. We'll put in the numbers. We'll look at where the numbers come from afterwards, but that is just a standard. Dealing with adding back on a lot of the non-cash expenses and the changes in cash. And then you have got your cash flow statement. You need to learn this off word perfect, word for word. And then you have a proof at the bottom. All of those templates need to be learned off. We also need to do some workings, and we're going to talk about the workings on this page here. But we will first off do part A1, which is completing the abridged profit and loss account to ascertain the operating profit for the year. We don't have the operating profit for the year 2018, but we're going to find it. And of course, if we want to find this thing at the top, well, we're going to work from the bottom upwards to get it. So we're going to start down here at the bottom, and we're going to say, how much was the P&L balance for the new year, the year 2018? Well, if you look at the new year's balance sheet, 2018, and the very last number, bar the capital employed, the profit and loss balance there is recorded as 35,600. And of course, what was the profit and loss balance for the previous year, or for the start of this year? Well, that is 42,250. Now, here, this will aid us in getting a retained profit for the year. So normally speaking, something, let's call it X for a moment, X add on 42,250 will give you 35,600. So therefore, working backwards, what you need to do is you need to reverse this function and you need to go 35 minus 42. And you're actually going to get a minus number here. This is minus 6,650, which means the retained earnings are a negative number in this situation, minus 6,650, which is quite unusual. How are they a negative number? Well, because I think this company may have paid out too much dividends. How do you get the dividends? Well, this is the first of our notes. It says the dividends, the total dividend, I'm looking at note 4, the total dividend paid for the year was 6 cents per share. And in the year 2018, we do have 510,000 shares. It's important you take the modern or the 2018 number because note number 1 says at the end of the question that those shares were issued on the first day of January. So therefore, for the whole year of 2018, we had 510,000 shares and at 6 cents per share. And when you multiply that out, that's going to be 30,600. Now, how do we get our profit after tax? Well, something less 30,600 gives you minus 6,650. So therefore that something is going to be 23,950 if you do that in the calculator. And then we're looking at our tax situation. And again, the tax is given to you quite easily in note number 5. It says tax on profits for the year was 51,000. We can simply put 51,000 in there. And then something minus 51 gives you 23. So therefore we add these back to get, well, that's going to be 74,950. Okay. Now, the interest for the year. Well, this is a slightly more tricky little working. This is interest payable for the year, and then this is interest receivable for the year. So the interest payable for the year, how do we work that out? Well, we need to talk here about the debenture interest. It says in the question that we had a loan of 80,000 last year. And it tells you that that rate of interest is in note number, oh, well, actually, no, it's listed on the debenture title. That is 8%, and that 80,000. Now we had that. If you refer to note number 3, we only had a loan of 80,000 up until the end of September, which is 9 over 12 months. So when you work that out, that's going to be, I'm going to do that sum here for a moment. So that's going to be 4,800. And then you had 120,000, which is the loan after it has been increased by 8%. And that's for the last 3 months, because of course we borrowed that on the last day of September, or essentially the first day of October. So therefore that is 120 by 8%, by 3 over 12, which is 2,400. And that gives you, the total of those two gives you 7,200. And that is your interest for the year. So I'm going to put 7,200 in here. Hopefully everybody's okay with how we got that. Okay. I could delete this. You could see. Now, then we have our investment income. Well, that's a slightly different one. I'm just going to do this further up. And we have an investment of 40,000 according to the balance sheet. And we're told that the investment yields us, and we're looking at note number 6 here, we're told it yields us a 6% return. And of course, that's for 12 months. And that's going to be a nice straightforward 2,400. There's no change in the investment. That's going to be a straightforward 2,400. So therefore, that is 4. Now, the important thing here is the fact that you are going to subtract the interest for the year that you pay, and you add on investment income if you are working downward. But in order to ascertain the operating profit, we need to reverse this function. So we are actually going to take our 74,950 and we're going to add 7,200. So that's 74,950. Add the interest which you have to pay and subtract the interest that you have to receive. And you're going to get your number, which is 79,750. And that is the operating profit. And that is the first part of the question completed. Everything there given to us in the notes, essentially. 1 or 2 little things had to be worked out. Investment interest received and investment interest paid. And the dividends. Everything else pretty straightforward. Now, then I would be inclined to take that information and go and do the workings of the question. Now, I've said to you before in the class that you need T accounts. Now, there's 2 situations where you may need a T account. You need a T account if you for fixed assets, depreciation of fixed assets or disposal of fixed assets. and we have a disposal of fixed assets, note number 2 advises us about it. And then you also need a T account if you have something which is common to your profit and loss balance, your profit and loss account, and your current assets or liabilities in the question. So in this situation, that criteria is fulfilled by tax, which is common to both the P&L and the current liabilities. Interest payable, common to both the P&L and the current liabilities, and the interest receivable, common to the P&L and the current assets. So therefore, we need a T account for all. So altogether, we need 6 T accounts. I do also have drawn down here a cross-check account for bank and P&L, and I might show you how to use that, but those are not essentials. That's just to check our own work. Now let's concentrate on the fixed assets first, the depreciation and the disposal. So I'm going to work horizontally here, and you'll notice first off that I've put in the opening and closing balance on every account here. And you will hopefully notice that if it's an asset account, the balance is on the debit side and then brought to be carried down on the debit side in the new year. So the brought down figure here is from 2017 balance sheet, and the carried down figure is from the 2018 balance sheet in every account. And if it's an asset, it will be a debit balance, and if it is a liability, it will be a credit balance. Interest receivable is an asset over here. So you need to set up that first up for all 6 accounts. Not disposal, we're going to do with that as we go through note 2. Let's look at note 2. It says fixed assets which cost 70,000 and on which there was total depreciation of 27 were sold for 41,300. Well, that is what we call a disposal. And if it is a disposal of a fixed asset, could be a van, could be a lorry, something like that, you need to take it out of your fixed assets account. So therefore, we're going to remove that out of our fixed asset account, and it's 70,000. And you're going to double enter that to your disposal account, where we can just call it a fixed assets, and we're going to put it on the debit side up here, 70,000. Now we also need to remove the depreciation, because when that lorry drives down the road, the depreciation on it, the wear and tear, is no longer your problem. How do you get rid of the 27,000 depreciation, which had been already provided? Well, this is by its nature a credit account, so to remove something, we put it on the debit side, or the opposite side. So again, we go disposal, and we're going to take out that 27. And again, we're going to double enter that from the debit side here to the credit side over here. 27. Now we're going to focus most of our attention on this disposal account for a moment. It says in the question that it was sold for 41,300. So therefore, that is how much we actually will lodge into the bank. That's how much money came in. So therefore, you can see whether you made a profit or a loss on this disposal by balancing this account. In fact, I think like the total here, which side is larger? I think possibly the 70,000 is larger. So you put 70 here and 70 here. And that means the balance is going to be above the lines on the smaller side, and that balance is going to be 1,700. And then you bring that down on the larger side, and if it's on the debit side, that is a loss on the disposal of 1,700. The green numbers in this situation are numbers which we will use in the cash flow statement. That's that account done. I'm just going to go back over to here now. We still need to pay a little bit of attention to the remainder of this. Of course, we had some depreciation at the start of the year, accumulated depreciation, and we had some at the end of the year. We got rid of some because we had a P&L figure. These two things, because we had, a disposal, but we also need to work out how much the P&L depreciation is for the whole year. And that profit and loss depreciation, well, that's going to be the balancing number here. If I add up the bigger side here, this adds up to 152, take away this 80, 72 is the profit and loss depreciation for the year on all fixed assets, including the one that you sold and perhaps some that you bought. Speaking of buying, over here, if we look at the actual fixed asset account, Well, this does not balance. Here you have 720 on this side, you only have 550 on this side. So as well as being told about a figure that we disposed of, we must have also, even though we are not explicitly told, we must have also bought some fixed assets. Otherwise, the balance would not be 650. How can you have a balance of 550 and sell something and end up with 650 as a closing balance only if you also bought 170,000 here? Now you have all three T accounts balanced with the same on the debit and the credit, and therefore your the numbers that you use. Now the numbers that we're going to use are in green, and also we're going to use this P&L number. So perhaps it may be worth our while putting that into green as well. That is the fixed assets and the depreciation. Now let's look at these three accounts here. And these are pretty much the same in all situations. What we're going to do is we're going to put in the P&L figure on the credit side for tax. Now the profit and loss figure, how much tax for the actual year do we have to pay? Why do I put that on the credit side? Well, because of course tax is an expense and it will be debited to the profit and loss account down here, whatever this number is. How do we know how much that number is? Well, there's two ways of knowing. Number one, you've been given it in the question. It's note number 5. Or you could refer back to your abridged profit and loss account. Here is our tax number here, 51,000. Either way, 51 is the number we're looking for. So you put 51 in here. That is our P&L. Now, how do we find out this missing number up here? This is the bank. How much tax have we actually paid? Now, of course, if last year we owed the tax revenue, the revenue commissioners 51,200, and during the year we accrued another 51,000, that is 102,200. At the end of the year, if we paid them 55, then by a process of elimination, at the end of the year, if we owe them 55, then by a process of deduction or elimination, we must have paid them the differing amount, which in this case is 47,200. How do we know this goes on the debit side? Because you could transfer that to the credit side of the bank. That is money out on the credit side of the bank. Now, you do not need this bank account at all here. I'm just putting it in as a cross-check situation. And of course, you could also have this 51 down here as an expense in the P&L. And again, we don't require this. This is just a cross-check situation. The interest is going to be exactly the same. You put in the P&L figure, which we have on the previous page. I've just replicated the working here for you. It's 7,200. And that will give you the bank, how much we actually have paid. If we had an amount due of 2,000 and we accrued another 7,200, and we owe our creditor 1,400 at the end of the year, we must have paid them 7,800. And from the debit side of the interest to the credit side of the bank, that's money out. That makes perfect sense to us. Now, finally, this one here is slightly different because remember, this is interest receivable. How much interest receivable? Well, you know, it's this 2,400, which we worked out earlier on. I have the working replicated here to remind us. Now that is the P&L number, but in this case, the P&L goes on the debit side of 24. And of course, that would be brought from the debit side here to the credit side, which would be an income in the P&L account, as it is. And the bank figure, the final figure here, well, that is going to be 1,200, take away 21. That's also 2,100. And that is, on the credit side here, it goes to the debit side of the bank account because, of course, we are receiving that money. Cross-check unnecessary, but just for checking, this means that this account is now balanced. In fact, all three of these are now correctly balanced, and we have the bank number in each case, which is the actual cash flow number. That's all of the T accounts required, completed. Now we can go back to our actual cash flow statement, and we're going to find where we get some of these numbers from. So the first thing here is the reconciliation of operating profit to net cash flow. Well, the operating profit we have just ascertained in part A. Our depreciation comes from the depreciation profit and loss figure in the workings that we've just completed, 72,000. And then the goodwill written off is another form of depreciation. We also have to add back on that. And that is 11,000 from 66 down to 55. It's 1/6 of 66 every year. And we also have a loss on the disposal of fixed assets, which we also need to add on. And that loss is 1,700 coming from this working here. 17,100 here. And here you have your depreciation. Why do we add all of these things? We add all of these things because they are all non-cash expenses, which would have been subtracted prior to the operating profit, but we are adding them back on because we're looking at cash flow. Then you have the increase or the decrease in stock, debtors, prepayments, provision for bad debts, and creditors. Please note here, I have written down decrease or increase. In the question that you answer, you must pick which one it is and only write that. This is sort of the template works in each case for me. But here, stock, we can see in the question, it has gone from 89,000 to 107,500. That is an increase in stock. How do we increase stock? Well, it will cost us cash, so that is a cash outflow. Debtors has also increased from debtors has decreased from 56 to 54, so that is an increase in cash. And we add that on, a decrease in debtors. No prepayments. And the provision for bad debts has increased from 1,200 to 1,600. A provision for bad debts, that is an increase in provision for bad debts, is a non-cash expense, which we need to add on, just the same as depreciation above. And then creditors, finally, well, creditors has decreased. And how do you decrease creditors? Of course, we would have had to pay them. So that is a cash outflow of 8,000. You take your 79,750 and you add up all of that to get 140,350. You know the template, it's just filling in numbers at this point. This 14350 starts us off here at the start of the cash flow statement. Now, here you have your bank figures, and the bank figures are very relevant here. The -78, the +21, and the -47,200 for tax, they are all these green numbers. Those three greens from the T accounts. Then you also have payment to acquire a fixed asset, that's the purchase of a fixed asset from the fixed asset T account. The receipt from the sale of the fixed assets, how much money we received when we sold or disposed of that asset. The investments didn't change. There were 40,000 last year and there's still 40,000. But the dividends, that's from your P&L figure, that is 6 cents on 510,000. You add up all of that to get -71,850. And then we have the after financing bit. Now, government securities went from 0 up to 27,000 in the question. So that is a -27 because we have purchased. Again, you must put down whether it is a sale or a purchase, not both in this situation. Now, the issue of share capital. Well, our shares went from 450 up to 510. That is an increase of 60,000 euros worth of shares. And of course, the question told us that there was a 20-cent premium on each share. So that's how we got 12,000. It's 20% of 60. Or we can take the share premium going from 0 up to 12. And then finally, the repayment or the extra borrowing. Well, we know that we borrowed an extra 40,000. So that is extra cash we have. So that gives you 40,000. The final answer here, the increase or decrease. Again, in this case, I'm going to actually delete this. So to emphasize the point, an increase in cash of 13,150. You have a written proof to do, but first off, you can do your simplistic proof. Here, by looking at the question, you can see that cash has increased by 3,150 and the bank overdraft has increased. In fact, the overdraft has decreased, which is an improvement in the bank figure of 10,000. 10 and 3,150 is that 13,150. And that proves, that's the quick proof. But of course, you're required to do this proof here, where you take your increase in cash and you put 13,150 there. You take away the issue of the new debenture and you add on if there's an amount to purchase liquid resources and you get a change in net debt of 150. You need to learn off this system here, 150. And then how do we get our net debt at the beginning and the end of the year? Well, you are combining together the bank, the debenture, the cash, and the government securities to get 104,150. So you're combining together now. That's minus 80. And you're going to have a minus 25, which is bank, and you're going to have a plus 0, which is government securities, and you're going to have a plus 850, which is cash. And that's how you get this number here. Now, how do you get the next number? Well, it's the exact same procedure. It is minus 120, minus 15,000 for the bank overdraft, but you do have government securities of plus 27, and you do have plus cash of 4,000, and that gives you 104. And when this 150 matches this 150 here, well, that is your proof confirmed. Finally, there is a part B of this question, which asks you about non-cash items. It says explain what is meant by a non-cash item and give 3 examples, including figures above. So the non-cash items are items in the profit and loss account that affect the net profit, but do not affect the cash situation. Depreciation, increase in provision for bad debts, goodwill written off. You have to include the numbers in that. And then 2 items which affect cash but not affect the profit. And you can read about them there. I'm going to leave that on screen. This is a good question to practice, and then you can go forward and try some of the other cash flow questions to reinforce.